Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, I'm going to talk about rules of thumb, some ideas that get thrown around a lot when it comes to retirement income planning. And although there may be some kernels of truth in these rules of thumb or ideas, you really need to be doing retirement income planning based on your specific situation, because the rules of thumb may not apply to you. Let's talk about those rules of thumb and maybe some alternative perspectives on each one. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement planning and overall wealth planning. So if you don't want to miss future content, make sure you hit subscribe. And if you like this video, make sure you click like. Okay, let's talk about the rules of thumb. The first rule of thumb that I want to talk about is the 70% replacement rule. Essentially what that says is when you retire, you're going to need roughly 70% of your pre-retirement income through your retirement years. I don't know where that number comes from. That has not been my experience working with retired clients over many, many years. And in fact, in many situations, after-tax lifestyle needs actually go up in the early phase of retirement because you've got more time, you're pursuing more hobbies, recreational pursuits, and travel. So do not assume that your income requirements are going to drop to 70% of your pre-retirement levels. That just doesn't typically happen. Now, does it plateau? Absolutely. And particularly as you get into your mid-70s to late 70s, we see a plateauing of overall income requirements. But that certainly is not the case in the early phase of retirement. The next rule of thumb is the 4% rule. Essentially, you take your portfolio value, let's say there's $1 million, that's going to generate $40,000 per year of income, and then you would inflation adjust that. And so the 4% rule says if you stay within those parameters, you will not outlive your capital. Well, there's many financial modelers that are saying that that's probably too aggressive. They're now talking about the 3% rule. But whatever rule of thumb you use is actually more valuable to have it modeled for you. Sit down with an advisor who uses financial planning modeling software to really determine what you need to be doing with your portfolio to generate the cash flow that you require, what kind of return assumptions are reasonable, and what the long-term impact on your portfolio is. So a rule of thumb is, I guess, okay, but it does not respond to the unique cash flow requirements you'll need from your portfolio. My experience is most people's cash flows do not go in a straight line basis adjusted for inflation between now and their life expectancy. There is quite a bit of variability in requirements from year to year because our lives are variable. There's all kinds of contingencies, opportunities that come up for us where we need to respond to those things by reaching into our hard-earned capital that we've saved for our retirement. Age rule. Age rule, this is a really, really bad one in the sense that the general rule of thumb is you need to be more conservative with your portfolio when you retire. One of the rules of thumb in this area is take 100 minus your age. So let's say I'm 60. That means that I should have no more than 40% of my portfolio in equity or growth investments. Now, that rule of thumb may be appropriate for you based on your specific risk profile, your comfort level around investing, but it could be disastrous for you in terms of maintaining your purchasing power over the last third of your life. When you retire, your life expectancy from an investment standpoint doesn't end. You don't all of a sudden become ultra conservative. Like I said, you might have another third of your life to live. Your biggest concern is maintaining the purchasing power of your cash flow on an after-inflation, after-tax basis. That is one of the biggest concerns. And you're not going to cope with that concern and that real issue if you become hyper-conservative when you transition into retirement. So be very careful about that rule of thumb. It doesn't mean you shouldn't be conservative. You just need to be just clear-eyed, very clear-minded about that particular assumption. Another one that's tied to portfolio returns would be the sequence of return or investment returns in a portfolio. So a lot of clients get concerned about, what if I retire and the market goes down all of a sudden? Will I be exposed to double jeopardy? In other words, my portfolios going down at the same time that I need money from my portfolio. So that is a real concern, although it's a low probability concern. Roughly speaking, out of every 10-year period in capital markets, the market is up between 70 and 80% of the time, and the market's down the remaining 20 to 25%. If you look at the average bull market or good market, its duration is roughly 9 years. If you look at the average bear market, bad market, the duration is about 1 year. So if you're hyper-focused on the sequence of return having a negative impact on your retirement, you're really focused on a low probability experience. Now that doesn't mean that you retire, you start taking money out and the market goes down and then you're in a bit of a tough situation, an anxiety producing situation. But there are other ways of responding to that. One option is to make sure you've got some cash reserves set aside that might be able to provide income for you over a 1 to 2 year period while we're waiting for market recovery. Maybe you even use equity built up in real estate. Maybe there's other alternative sources of income you can tap into so you don't have to sell financial assets at a bad time. So I'm not saying you don't worry about it, you don't plan for it, but it's a low probability circumstance through your retirement years. The next one is Canada Pension Plan. So there are all kinds of rules of thumb out there. What I would say is with your Canada Pension Plan benefits, my experience has been that most people do take their Canada Pension Plan benefits early. I think one of the reasons for that is they've put money into the plan for, let's say, 40 years. The survivor benefits, if they die prematurely, are meager, and so it's sort of this take the money and run mentality. They justify that as well because maybe they could use that cash flow from Canada Pension Plan to take pressure off their own investments. Maybe they'd even use it to save money if they didn't need the cash flow. So that's been my common experience. The average age that people take it seems to be around that age 62. However, that's not right for everyone. I could talk to a client that's very concerned about longevity risk and outliving their income. So those folks may decide that they will defer taking Canada Pension Plan. So most of you, if you're healthy at age 65, are going to live to average life expectancy and likely exceed it. So the bigger risk from, take the money and run just in case you die prematurely, that's not the real risk. The real risk is, will you outlive your income or capital? And for those people who are concerned about that, deferring the pension past age 65, so every year you defer it past age 65, there's a 7.2% annualized increase in the income, and that locks in higher, consistent income for those people that are concerned about longevity risk. So those are probably the main areas that I would, think about when I look at rules of thumb. The best way to plan for retirement is not to use rules of thumb. That's a starting point. What you want to do is have your own customized retirement cash flow plan put together that ties in your pension plans, your government benefits, your investment assets, your lifestyle goals, your aspirations into one unified plan so you can make sense of the different strategies that would be appropriate for you. How much after-tax income is sustainable? What kind of returns do I need to get on my portfolio? How do I minimize tax on my income? Those are just a few of the questions that your plan will answer. Now, if you're interested in knowing how you can get a complimentary retirement income plan, just visit our website. In the show notes is a link to our homepage. When you get there, there'll be a discussion on how you can access a complimentary retirement income plan. Again, if you're not subscribed yet, make sure you do that so you don't miss future content. And of course, if you like this video, make sure you click like. Wishing you all the best in your retirement income planning journey and your overall wealth planning. You take care.